that anybody had. There was some issues that came up, but yeah, happy to be here and looking forward to it. Hello, everyone. Clayton.
And joining me from WealthE Migrate is Aubrey. Aubrey joined us in December last year. We're excited to have him on the first webinar that he's been on with us.
Hi everyone, thanks Lee. I'm really looking forward to being involved a little bit more with the community and just growing a little bit with the company.
Great. So just as is tradition with our webinars, we just like to know that everyone knows where the question button is. So you can find the question box on your screen. If you wouldn't mind just popping in there where you guys are joining us from. We've got a large amount of people that have joined us for tonight. So just let us know where you are, and then throughout the webinar, feel free to pop your questions in. We'll make sure that Garth and Clayton answer those as we carry on through the webinar. So we have people from Switzerland, North Florida in the US, Cape Town, Pretoria, Durban, Abu Dhabi, West Sussex, Saudi Arabia, Soweto. So as you can see, we've got a very mixed bag of global citizens with us tonight, and that's exactly what one of our standings are, that we want to be a global community. So thank you to everyone for joining us. It's really great. So I'm going to jump right in. I know that Garth and Clayton have got so much valuable information to share with us. So I'm just going to get through some of the WealthE Migrate stuff, and then we're going to hand over to them. So I know Scott has been speaking to you quite a lot recently about WealthE 5.0. For those of you that have been involved in our community for a while would have heard a lot about that. And 5.0 actually came from Society 5.0. And what it is it's made up of 5 pivotal points, which is your impact, high touch, high tech, digital. And tonight we're going to be speaking to you from a point of high touch, which is collaborative smart investing. And that is what Garth and Clayton are also going to be sharing with us a little bit, how we can use it all together and we can really enhance our own portfolios and become true global citizens. Part of our journey is also education. We created the WealthE Starter Pack, which allows people to have the education and start their global journey. It includes things like our inner circle, where you can join with like-minded people in a community where you ask and you grow, and you have monthly seminars, very much like this one, with experts that teach you on a variety of wealth and its holistic wealth, and not just your actual monetary wealth journey, as well as get a $100 voucher to start your wealth journey. Now, as you know, if you've been involved in our community, we have a minimum investment amount on a Wednesday, which is $1,000. But with the WealthE Starter Pack, you actually get to start with $100. So if you'd like to know more, you can see there, it's online.wealthmigrate.com.start. You can just go and have a look and see if that is something that you would like to do, and join us on that. I'm just gonna, sorry guys, I seem to have, can you tell me what you're seeing right now?
We lost Lee there. There we go.
Yeah, I think you've stopped sharing.
Can you guys hear me?
Yes, we can.
Okay, but you can't see my screen anymore? I seem to have lost it. Okay, well, in truth, you can see me, but not my screen. Okay.
I can't see your screen, yeah, we've lost your content, yeah.
Okay, well, in true, for a technology company, these things happen, and my screen has gone black, so I'm pleased you can still see me. So I think that we will just hand straight over. It means that I need to stop waffling and hand straight over to our experts that have joined us tonight. So I'm going to hand over to Garth and Clayton and see what they have to share, and maybe they can just start us on who they are, what they do, how they do it, why they're excited about what they do, and take it from there.
Yeah, so Sure, that's a lot of content to talk about. So, you know, having done one or two of these things before, not, you know, fear of boring everybody to death. You know, I think the reason I couldn't make last week is I wanted the markets to crash. I wanted coronavirus to do some proper damage, you know, so that we could really have some valuable questions tonight when we got here. So I think we're in a very different situation. So it's almost fortuitous that, you know, things got delayed by a week, because the world is a very different place from last week, Wednesday, to this week, with, you know, some of the changes in the oil industry and what we've had there. So yeah, let's just start with who we are. So Callio Capital was formed in 2011. You know, the majority shareholders and the CEO, myself and Nick Liebman, share the role as CEOs of the capital of Callio Capital, and you know, we've run the company successfully for 9 years out of Johannesburg, Houghton, offices in you know, Woodstock in Cape Town. But the company is born out of a very interesting understanding of South Africans' financial history. And this applies to global people, because for you know, for South Africans, we sat in an isolated environment. So in the global environment, and even in the South African environment, banks and investment companies controlled the narrative of what people invested into and how they were receiving information. It was very much a product sold industry. So we got very disillusioned with the traditional private banking and the investment banking sectors, and broke away to form, you know, what was our collaborative relationship with clients already, and to build a family office, and a true family office. And that's where Callio was born out of. So, you know, we focus on the best solutions anywhere in the world, and delivering the best advantages and investment opportunities to families globally. And, you know, we don't just play within the investment market space. You know, we are very cognizant of all the risks, and that's what we bring as a family office. So yeah, that's effectively what Callio is. It's broken up into private equity, property equity, risk management, consulting, corporate finance, and yeah, asset management, particularly focusing on, you know, the global markets and externalization of wealth. So that's who Callio is. And Clayton is a shareholder of Callio and heads up the asset management division, runs our global, you know, our global strategy, and with me sits on the head of the investment committee, and, you know, helps with the decision. So effectively, that's who Callio is. And, you know, I'm always asked this question: what is a family office? You know, it's one of the most commonly heard words out there. And people go, but what is a family office actually? You know, so a family office traditionally started with high net worth families, and the high net worth family didn't want to follow the traditional routes of investment. By the traditional routes of investment, they didn't want to approach a bank or approach a financial institution, give them their money and see how things turned out. They effectively took control and said, let's build our own investment portfolios, let's do our own research, let's build our own business opportunities, let's take our family's wealth and our legacy wealth and build the structures and the risk controls and mechanisms around that. And that's where we built the Callio family office. A family office is something you should picture like an architect. You know, somebody who draws the blueprint of a house or a building or a palace or whatever you're building, but has the know-all of all of the areas in the family. So that's what a family office does. It assesses all risks within the financial realm, from business decisions to global decisions to banking decisions, and finds the best opportunities, you know, for that family to preserve their wealth, protect their wealth, and create a legacy and a generational plan behind that wealth. So that's what a family office is.
Yeah. If I can add to that as well, I think what's also so important is that through our experience of doing it and dealing with multiple jurisdictions and clients and families that have different goals, we have access and relationships with some of the top and basically tax advisors around the world, accountants, you name it, that we can draw in, lawyers that we can draw in to focus on very specific questions or scenarios that you may be dealing with, and or very specific outcomes that you may have in other jurisdictions even.
So that's a family office in who Calio is. Yeah, so I mean, I sort of move on to, you know, some of the obvious concerns out there just in, you know, talking to a broad-based community. And I think one of the biggest things that people are really asking right now of us and, you know, looking to us, because, you know, remember we're a multi-family office. What that means is a family office would normally look after a single family. Let's say I'm the family office to the royal family and I do all of the financial, you know, instruments and everything for that family. The multi-family office treats every client to get the value out of the family office. So we treat the client base of Calio as the family office. But we do manage, you know, extreme wealth, and we manage that wealth in now probably it's 14 different countries and, you know, around 87 families around the world. And I think it's important, and everybody wants to know, what are wealthy people doing right now and to protect? What risk measures are they taking? Because a lot of investment management and a lot of family office management is about risk management, you know, legacy risks, business risks, environmental risks, geographical risks, political risks, you know, for etc. So what are people doing, you know, to protect, and what are wealthy people doing from a risk point of view? And I think there's that word that always comes up, and that's diversification. So I just want to talk to diversification and what does that mean. So it doesn't matter where you live in the world, we've got to be sort of aware of what different countries contribute to global GDP. So we understand that America, the USA, contributes between 60 and 70%. The next major contributor is China, and then it goes down, and you eventually get down to emerging market countries like the 'S, South Africa, and the BRICS, which contributes about 0.49% to global GDP. And how do wealthy people protect against, you know, market crashes? And it's diversification. And that means you must understand the difference between the different geographies. So emerging markets and developed markets are very different fundamentals. So people diversify. Property doesn't necessarily move in the same straight line as equities and as fixed interest. You know, it's got income coming from it in rental income. So diversification is always going to be your risk, but not just diversification across asset classes. And asset classes, equity, property, bonds, you know, fixed income, in different currencies, for example. So to protect against risk, it's always the never have too many eggs in one basket. So, you know, that's one of the biggest risk diversification, risk tools is diversification. Sorry, Claire.
Yeah, if I can add to that, I think also for us what's very important is flexibility, a strong grasp of macroeconomics, so that we, when it's appropriate, we do take views and we go after those opportunities. For example, like we saw now, where we went to cash and we went to US 2-year treasuries to protect ourselves during a very difficult period now, which we were anticipating. So I think that diversification and knowing when to bring in the right asset class, the right opportunity is very important.
Yeah, I mean, you know, I'd love to get more specific questions around risk and, you know, what people are asking, but, you know, I want to talk further to that. And, you know, I think managing risk is about an initial plan. So let's just ask, you know, what a family office does. I mean, the first thing is when you draft an objective for a family, when you draft an objective for a person's wealth, that is what keeps you on the course. And it's very important. One of the most important aspects of wealthy families is good planning. Okay. When I say good planning, is these people don't throw darts at dartboards. You know, these people have very clear strategies and very clear planning stages. Now, remember, money and markets have been going up and down for 150 or 130 years. And there's always going to be opportunities. So people always feel the here and now is very different to tomorrow and the next day. These things go in plans. So I think in cycles, and I think it's critically important to understand for any person listening what your plan is and what you're trying to achieve. Because a wealthy person doesn't react to the markets. They stick to a strategy which is predefined and a pre-planned diversification. So they'll say, I would like to, because of the performance of the S&P 500 and the size of America, have an exposure of 60 to 70% in America, for example. And then they stick to their plan. So they're not reactive to the market conditions. And they know the highs and the lows and the neutral and the overweight and the underweight positions of their portfolios. So I think it's critical not to run for the hills and disrupt your plan or suddenly think your plan's look. You must always be flexible to opportunity. Particularly at times like this where you get a double whammy of Corona and then throw in a Russian and a Saudi Arabian conflict of what oil prices should be and flooding the market. And that's double whammies which push the market. These present fantastic opportunities. And when those opportunities arise, that's where your plan can be rejigged and you can adjust. But, have a plan that sticks to that.
What's very interesting also, what Garth and I often see is that you need to make sure that your family has placed the money where it needs to be, ready to go after those opportunities as soon as they present themselves. Because if you wait till that moment and then start looking at it only, you've missed the bus. These things come and go in a flash, and I think what's very important about our role is us assisting to make sure you're in the right platform, the right jurisdiction, ready to go after opportunities as they present themselves, because they move very quickly.
All right, so there's a lot of information. Lee, do you want to interrupt us here and just see if there's any questions or things you want to guide a little bit more in a direction?
Well, you sort of touched on the coronavirus, and I know that there is a lot of buzz that's going around, rightfully so, with the coronavirus. We saw that the New York Stock Exchange suspended trading the other day. I mean, so what is happening in your view with the global markets and the global economy in relation to the coronavirus at the moment? What do you see is happening and where is it going? Where's it going to stop?
Does anybody out there need another view on coronavirus? It's an information virus. Okay, let's be serious for a second. Okay. It's a very deadly flu, and it's not understood at a level of influenza. Okay. It's not understood whether it can cause permanent damage to your respiratory system, and we've seen this before. So when we do research on coronavirus, we don't do research on the medical side of coronavirus. We do research on SARS virus, we do research on the effects of AIDS and previous viruses and what effects these things have had on the market. So I'm no medical expert and I couldn't tell you the difference between SARS and Corona, but I do understand human behavior. And I don't think I would get on a plane and travel to northern Italy today with what I don't know about Corona. So we can say it's irrational panic, and we can say it's an information demic, and we're blowing it out of proportion. But the reality is, I as a human reflect on it, and I say, would I get on a plane and go to northern Italy to experience something I don't know what the long-term outcome is going to be? We didn't know that with HIV, we didn't know that with SARS, we didn't know it with swine flu. However, the realities are this: the disruption of this is much greater than any epidemic we've had before, pandemic we've had before. These disruptions are greater because Facebook has something like 48 times more users than it had at the last virus. The Instagram information, the speed with which information spreads and with which people can panic is alarming. So that effect on the market is very real. To bring in perspective, even if the information flows slowly, previous discounts to market and previous effects on markets were in the region of around 10 to 12% on average. Okay, let me just say that again. Markets came off around 10 to 12% on average with SARS. The one that caused damage that didn't recover was HIV, which is the only one which reflects a negative effect on the market. All of the others saw as much as a 16% recovery in 6 months after stabilization. So to understand Corona and to understand news, what we need to look at is China, you know, reflecting and saying, here I am, the president, I'm standing in the epicenter of this, and we're confident that we've got this under control. I don't think people should suffer from conspiracy theory and say, oh, well, they're just feeding information. You know, I think what we've got to understand is the world took this very seriously. And airlines like Emirates grounding itself to be the first one, it took it very seriously. So the disruption that you have in the market is very real. Production declines are very real. But take the oil side out of it. I feel the 15% and the social media panic caused a 15% downside on the S&P 500, a 20% downside on the FTSE 100. You know, other MSCIs down around 16, 17%. It is a very strong whack. Okay. And I think people need to understand that before Corona happened, the market was perfectly priced. The only country that was effectively still growing and only at around 2% and pretty slow was the USA. So this market was perfectly priced. It wasn't a market that was about to shoot the lights out. There was global slowdown. And with that being perfectly priced, I feel the market would have sold off at any opportunity. It was waiting for a calamity. And that arrived. There are spill-off effects, but I feel a lot of the effects of Corona have been priced in. And, you know, non-production for a year on a company such as Adidas or Nike, and the effects of that is a 14% cost to them. So I feel a lot of that's priced in. What we didn't factor, what we can't factor into the numbers is the oil crisis on top of that. In 2016, a very similar oil crisis at $28 a barrel arrived. And that on its own drove the market 13 to 14% negative. Okay, it did correct. So it's not all bad news. I feel we can see further downs. We saw a correction of, you know, we saw a reboot of the market by 4 to 5% last night in the US. And as I'm watching it now, sitting here, we've lost and given up most of it again. Yeah. Now we're down 2.8 S&P 5 and 3.8 S&P. Yeah. So when you look at these things, the most important thing people need to do is to take a long-term perspective. If this is a black swan apocalypse event, it doesn't matter how low your portfolio goes. The only tradable commodity you're going to have is, you know, land. So we can't say this is the end of the world. We've got to statistically know that we've had proper crashes, and the crash is technically down 20% in US dollars. If we take a technical crash and we take the 9 or 10 big technical crashes in history, the average is minus 23. So we've come very close. We've had 19 yesterday before it came back and bounced back with measures, you know, by the Fed to cut rates if need be.
And this was also the fastest, actually, interestingly enough, movement down that we've seen ever. So this has been the fastest correction that crashed.
But I also think the speed of trading with information and that is, you know, that is something we've got to be aware of. Things move faster. But we have a philosophy that if you are taking a plan now, and the family had said, I want $1 million income from my portfolio is $100 million, and to achieve that, I've got to look at the statistical averages of the markets to achieve that. Historically, this is a very good buying level. You could be wrong and see another 7% down. But would you have bought the market 2 months ago, entering the market, not knowing about coronavirus? People were entering the market at the high. The reason they were entering the market at the high is because there's no interest rates. Where do you go to get return? So unless you're getting income from property, okay, where are you going to go for a yield? So people pull out of the market and they go, okay, I'm out, I'm scared. And then they go, now what? And now the market is cheap at 20. And they go, what's the chance of this market going up 3% or me paying this Swiss bank negative, I'm paying 15,000 francs a month to them to keep my money. Maybe that 20% discount looks attractive. So what you've got to be realistic about is there are very realistic events. We don't have a crystal ball that says this is the bottom of the market. We know historically that there wasn't a lot of growth, that we've gone up for 12 years, that having a technical crash at 20% is not the end of the world. We do not have 110-year-old companies going out of business. What worries me more is the oil, because there are going to be small oil operators in Texas that are going to go out of business if this continues. Do I think the staring contest between China and Saudi Arabia that somebody's going to pick? I do believe somebody's going to pick. I don't believe they're going to cut off their nose, their ears, their arms, and their legs to spite their face. So like 2016, when this oil crisis happened, there will be casualties. Okay, we've already seen people taking measures and putting holds on projects and that to not proceed. But I'm very confident, and to stick my neck out there, because I've got to make real decisions. I can't sit on the fence. I do believe if you are in a neutral position in your portfolio, you are exposed enough. If you are underweight, I do believe you can move 10% to markets around the world. And I do believe you'll be very surprised when things stabilize, how quickly it can turn. But you've got to look for the opportunities. You've got to be, you've got to be sensible about what you're buying in a crisis like that. You've got to look at companies. You've got to look at the future. You've got to look at the switch from developed markets to emerging markets. But in crisis, there is opportunity. Corona is scary, but this too shall pass, like every other calamity we've ever had, 9/11 and everything else in between. It will pass, and the world might be slow for a long time. And that's got to do with a much bigger global move, which we'll talk about, for the next 10 years looking forward. So yeah, that's my view on Corona. And with the double whammy, I think the markets have held up well. I think there's another thing very important. That's very important to remember. 92% of the capital in the world is managed by investment managers, banks, and asset managers. Okay, private equity, property equity firms. And they control how far the market bottoms out, and they control the selling. And what I mean by that is when it gets too cheap, it keeps stopping. Because there's only a panicked sell that is not necessarily educated to long-term investing and manage their own portfolios. And that's relatively small. And this is the danger of ETFs. As liquid as they are also very capable of being sold at such a rate that they cause a panic like Monday on the New York Stock Exchange. That's why they hit the kill switch. It's like stop, breathe, let's halt the selling, let's allow logic to come back in and look at the effect of how they did. The managers, the people that control the flows of capital, said, okay, no, it's sensible to actually, this is too cheap. So I think we're reaching an equilibrium of buying and selling, like we did. Yeah. But we're reaching that equilibrium of buy and sell. So yes, it can go another 6-7%. I don't believe this is 2008. I don't believe we've got a debt crisis to that same level. I think quantitative easing and throwing money at the problem is concerning. I think that's a major issue for me. I don't think that's necessary. That's got to come out of the system at some point. And that can take 7 to 10 years to unfold. I think for the most part, people should realize that this double whammy is held up well. It can go lower, but how much lower? I would say 23, even 25%. I'm all in. I think that's a great level to buy for plans that are 5 to 7 year plans and are equity plans. Wouldn't be that for my income, but that's a different story entirely.
I think if I can add, we always look at scenarios. So there's a small sort of allocation probability that we could see coronavirus continue to really halt things. But even then, we know that this will provide opportunities. And as long as you're not fully invested at this moment in time, you will have cash and opportunities to go after these opportunities. And I think that's important. That we are in a position where we do hold cash, we hold bonds, etc., that we can move quickly into the market as we see opportunities present themselves. So yeah, and also the same as coronavirus will not be the end of the world at all. Not. Certainly not. Certainly not. But we will slow things down severely, as we're seeing in the likes of Italy, but it won't be the end of the world.
Look, we know they've already got virus, antiviruses and potential solutions to this in testing phase, and that this thing's going to roll out probably 3 to 5 months to stabilize. And in 5 years' time, we may remember as much as we do about SARS and everything else that we had out there. But this one's serious because there's just so much information available, and it just spreads so much more quickly. But there's so many opportunities in this space when this is protected. I mean, Netflix, you quarantine, Netflix shares prices going up. Let's be honest. You quarantine, online shopping, Alibaba, Amazon online shopping is going up. You sit in a hotel room long enough, you get quarantined in, some small country, and you've got access to internet. I can tell you which company is going to do really well out of this. And, you can see that from the research of the previous viruses. There was a 9 times multiple in Alibaba's retail over the SARS virus. There's massive influences on this, but game parks, Disney closed down in Asia. That's real revenue. We only need to know, coming from South Africa, where we have strikes, what the revenue consequences, when we have power outages, what the revenue consequences are of those events. To understand the global disruption of something like this, take it seriously, but within reason.
And I think what's very interesting is what is important is to be careful not to indiscriminately hold assets. So we are not holding indexes that hold various assets that can be seriously affected. Instead, we're very focused on the quality businesses we want to own that we know will survive these sorts of events and continue to produce very good cash flows and grow.
Right, that was a mouthful.
Yeah.
Lee?
Great, guys. Let me I want to jump in. I want to change the sort of like topic that we're on at the moment. At the last time we met up in Joburg, you mentioned that unless the people that are investing more than $5 million at a go, there's no need for efficient structures, that sort of thing. And I was wondering if you could just elaborate a little bit more on that, why you would think that, why should people be focusing more on good opportunities to invest than actually trying to be more efficient with their sort of structures, etc., in your opinion?
Right, so let's just, I want to bring a bit of perspective to that question, right? Because, what are we asking when we say structures, right? Structures, a structure is having an investment account. That's a structure. So I'm not saying more than 5 million, that you need a structure. You always need a structure. As simple as a structure is, you need a platform. You need a portal. You need an online share portfolio. That's a structure. You need a structure to buy. When we talk of structures in the family office, we are talking about the elaborate ability to do business globally. We're talking about tax efficient structures to conduct property and protect rental incomes and that. The 5 million market I mentioned, 3 to 5 million, I think was the number I gave, is where we start talking about global trusts and legacy planning. Because a lot of people set up a trust for this perceived tax advantage. And that is something that you've got to be very careful of, because the tax advantages of trusts don't really exist, and the European Union is having, place of effective management of all of these things looked at. So what I'm saying is these very elaborate structures, people years ago took their 10 million allowance or they had $1 million and they bought this elaborate structure, and you know what, they got punished for it. It ended up costing them more in back taxes. And all I'm saying is the cost effectiveness of global structures for a global citizen is not viable because of taxation and global taxation. All this quantitative easing that we've had, all of this funding of the markets, because we're talking these technical terms and I want to avoid the jargon, all of this funding to float this market that created this 12-year bull run is debt. Okay? So the world has to collect debt. They collect debt 2 ways. 1, interest. 2, taxation. So this common reporting standard, this thing that exists, is 72 countries, and these 72 countries agree to report to each other. In countries such as Isle of Man, in countries such as Switzerland, the obligation to report to each other for tax purposes to the US through FATCA, through FBAR reporting, these fancy things. All it says is, if you've got money in a bank account, the trust is not going to protect you. So it can be very costly, up to $5,000, $6,000 a year just for straight custodian fees to run these structures. And the principal reason you set up structures is legacy planning, generational transfer of wealth, estate planning, legacy planning. Those are the principal reasons you do it. So when we talk about structures, we don't want people to run out there thinking that investment structures need to be in place to enter markets. All you do is add a level of complexity and cost. What we want people to do is build global businesses, become global citizens, where the 10x factor, the 10x event in companies that they're going to own, that those are the things that are owned. Because when exponential wealth is created, it's too late after the fact. So I've always said you've got to spend time on what your legacy is going to be and understand what your growth factor can be and get proper advice on how best to house that. That's our biggest thing in a family office, is the correct housing and structuring. And for any person out there, it's a case of providing the correct structure. The correct structure might be to hold an investment account in your own name. The correct structure might be to hold your investments in an investment company, because you're going to build a big property portfolio. Now, what you don't want is income in your name. What you want is a company somewhere out there in the world to earn the income. And when you need to take a dividend from your company, you can. So whatever level of investment you're going to do, you've got to set up appropriate structures. So that was a bit of a blanket statement about trusts and what we know as structuring, which is trusts with companies. It's very expensive to do that, and it really is a break-even point. And it is on financial investing, not on the 10x factor. If you are running companies around the world, then there's the position for exponential growth in those companies. Consult to a family office or consult to somebody such as ourselves to get the correct advice for the jurisdiction that you're going to be doing it in. You can't fix that after you've made the mistake. There's no going back. So rather spend the time on planning. Okay, don't worry about the here and now. Spend your time on planning. It will always pay off in the long run to have the most simple structure you can have for the level of investment you want to make. Global tax, major problem. They're going to find you wherever you are. Okay. Read questions out if they come in that you think are pertinent. But Aubrey, carry on with your line of interrogation, because I've got a big light here.
Sorry, I'm just going to jump in here, and I'm just going to ask a question.
Don't do what we do. Just touching our faces.
We're actually in quarantine today.
Yeah.
Sorry, Lee.
I'm just going to jump in here quickly and just ask you guys, because one has come through, and it's about structuring, but about estate tax on death, and how you leave your investment structures like Wealth Migrate and that. What happens to your tax and estate duties on death if you've got investments in properties and that? Do you do it in your own name? Do you do it in trusts? As a non-South African tax resident.
Okay. So that word resident is critical, because unless you can afford to never be resident anywhere for a number of days, so that you don't pay residency, you are going to buy a tax resident in one country or the other. So to answer that question quite succinctly, I want to say that the US is different to the UK. So you've got to look at where you are living. The state duty doesn't exist in all countries. Okay. So I can give you a realm of information here. If you're a tax resident in the USA and deemed to be domiciled in the USA, for example, and you own property in the USA, and I mention this because I know Wealth Migrate has a fair amount of US properties. If you're a non-US resident, anywhere else in the world, you pay a tax called situs, S-I-T-U-S, situs tax, which is a Latin word for basically on site. Same in the UK. If you are a resident of another country, a foreign investor in the US in property, and you die, okay? you pay US estate duty tax at the highest level. You have an $80,000 transfer, free abatement to your wife. You have a £600,000 abatement in the UK on citus tax. So the quantum of investment you have, if you are married, it's different to if you're not. Remember, I've always said this to 100 people. Estate duty in most countries is not your problem, it's your children's problem. It's not your wife's problem, it's your children's problem. So they must buy a life policy on you and pay for it. But estate duty, the reality is it's about where you're domiciled. In the UK and the US, you've got to be very careful of because they impose site-based taxation. 50% in the UK, I think 45% now in the US, on a site-based asset. However, you've got massive abatements on if you live in the US. So that's a very difficult question to answer because it's got to look specifically, where are you living? Where are you tax resident? Where are the investment properties you hold? Okay. If you have a will in Europe or in the UK, you can actually solve a lot of those probate issues and the issues that you have around this. It can be as simple as having a foreign will if you're not a resident of that country. But the big one you've got to watch is the US, and you've also got to watch trusts and how you set up trusts in the US, and the quantum then becomes what I was saying earlier on Aubrey's question. You've got to calculate that very clearly. But for the most part, just be aware of citus tax and assets in those countries, and we can advise on that structure. I'm not going to do it on an open forum because it's very intellectual property, and it's very specific to each and every person. Yes, best to just remember it's your children's problem, estate duty, and a property passes to your surviving spouse, and they only pay estate duty. Your children pay estate duty on the death of your spouse. So that's the generic playing field you've got to remember. But yeah, it's about quantum again. If it's under 600,000, you have a husband, you've got no problem. If it's over £600,000 based in the UK, you've got a problem. Now you must get wills and things drafted. So yeah, it's not an easy question, but it's your children's problem, not yours. They must work.
Perfect, thank you. Jamil, I hope that sort of answered your question. I will reach out to you and I will hand over Garth and Clayton's contact details for you. And maybe it's worthwhile you having a meeting with them and discussing this further.
Or just pop the question to us on email, and we can tell you what we need to give you a succinct answer that is specific to that question. Okay. Next question. Aubrey, you're looking keen for a question there.
Sorry, I couldn't unmute. One of the things I wanted to ask is just back on the track I was asking just now, you mentioned global citizen, and I just wanted to ask, just for everyone in attendance, what does being a global citizen mean to you? What is the definition of it? How would you realize if you're a global citizen, etc.? What does that mean to you?
Well, a global citizen is somebody who lives on the globe. So if you're currently present on Earth, you're a global citizen. So a global citizen is very different. My parents grew up, and getting on an aeroplane and going overseas on holiday was a big thing. Now we see 6 countries in a year, and we flit around and we put an IV in to get over jet lag, and we carry on 3 days. The world's a very small place, and in talking about a global citizen, it's nice to make a parallel to Corona at this point again and say, we have the means to work much more efficiently. We have the means to invest much more efficiently. That's why some of these things don't have the same impact they used to have. A global citizen for me is somebody that is not making decisions by the jurisdiction or by the house that they live in some country. A global citizen understands the world at large. It understands the opportunities at large. A global citizen is a person who views their income in hard currency and views their investment planning in hard currency. You must never, ever be restricted by where you live as being the be-all and end-all. The global citizen invests all around the world in all currencies and takes opportunity of all advantages and disadvantages of the globe, and has the ability to live as a global citizen and not be beheld by the political decisions of the government. Okay. They understand the rules, they understand the globe, and they are able to effectively take advantage of the global opportunities. And we can today. The speed we can invest anywhere in the world, the cost that we can invest anywhere in the world, the ability to change currencies anywhere in the world, that's what a global citizen is. A person who's embraced that change and that disruption to all of the industry and uses those to their advantage around the world.
And it's more possible than it's ever been.
Yeah. So yeah, that's what a global citizen is. And, you know, as Calio, it's very important to realize that, you know, one of our biggest focuses is to embrace change. You know, when we talk about legacy planning and we talk about managing wealthy families, we are already trying to educate the wealth creator. So let's say I've got this guy. He's the dad, he made the money. You know, he's got, let's say 2 children that are 6 years old. Those children will be employed and be doing things that don't even exist yet. So when you do legacy planning, when you start protecting wealth, your structures and things need to incorporate the world that it's going to be in 20 years. Your education and your ability to speak to the next generation and to understand the world that they're going to be in is so critical to bring into your planning. And that's part of the global citizen thing that people need to understand. The world we're coming from is not going to be the world we live in 10 years' time. And 20 years from now, this is going to be a very different world because of the pressure we put on the planet ourselves. The global citizen is somebody who is investing in a different way. Quick, streamlined, but also is now controlling the outcome of the planet. And when you look at, you know, conscious investing is one of the biggest themes out there. This is a global theme. When you talk about opportunities, you know, people used to talk about opportunities in, well, oil price is cheap, buy oil, that's an opportunity. When we talk about opportunities and being a global citizen, are you aware that the funds that were structured into a impact investing portfolio last year, previously people made conscious investments. They didn't want to invest in companies, for simple terms, they didn't want to invest in companies that were bad for the planet. They didn't want to invest in companies that were bad for human beings. That consciousness around how people invest is one of the biggest opportunities and investment themes. So companies are changing the way they do business. And those companies are attracting more investors and were the highest performing investment companies last year. And these are where the opportunities come. This is what global citizenship means. This is what recognizing trends and adjustments and changes that anybody on this panel needs to research and start looking at tonight. Or having somebody who's plugged into that, having a community like this, the ability for people to sit in Saudi Arabia tonight, for people to sit in Switzerland, you know, and to be able to communicate like this real time across countries and to get information on things like this real time and to make different decisions. And, you know, you could get specific. I could do a webinar now on how to invest for legacy. It could be an hour on its own. You know, the ability to get information is real. People don't charge for this information at $6,000 an hour anymore. That's how the world is changing. That's what a global citizen is. Get on with the disruptive changes. Be part of the change or you're going to be a dinosaur.
I think it's that idea of that there's opportunities out there that you action it, that you do it, that you align yourself like you are right now watching this with Wealth Migrate, but that you're making sure that you're going after those opportunities, because the one thing, the biggest lesson I've learned in life is that there's always opportunity.
Sorry, guys. Just one last question here. I know you want to jump in, but I sort of saw one handing there. Just at the back of that, Garth, and talking about people doing a lot of research and keeping up with the times, etc. What sort of recommendations, if you guys have any, would you recommend for our people on the line, for like maybe like a morning, just a quick website to view in the morning, to see what's keeping up with the times, you know, things that are relevant, things that aren't sensationalist, you know, well, what would you recommend if you have any?
You know, as much as I say information is real time and that, what I look at is factual information. You know, we We have a very interesting dynamic in Calio because the guys that run this business are very A-type personalities, very strong, driven personalities, and opinionated people. Now, the reason I bring that story in is for a very important answer. Information creates debate. Okay. Decisions are made on fact. So there's two very different things. We don't look at news because, one news channel might be supporting the Republicans in the USA, one news channel might be supporting that. The human ego wants people to be on Bloomberg and they'll say anything. People have agendas when they're doing that. So I never look at opinions. Okay. I only look at fact. I only look at what are the facts about agricultural trends in Israel. Okay. I'm a numeric person. I make decisions on facts. When we sit with these A-type personalities, we can have all the opinions in the world, but they have to be backed up by fact. If they're not backed up by fact, they mean nothing. So a good website is always Bloomberg. Okay? A good website is Financial Times. A good reading is, just to get the fundamentals.
No, the International London.
But I also think the communities like WealthE, Migrate, and the postings from respected communities are the ones that people should go out there. I don't want to pun names, and I also don't want to diss any institution out there. There's a few that I can tell you I definitely would avoid. But I'm also not going to put the names out there. And the reason I'm not going to do that is because you've got to look at the actual factual information, and then you've got to source. You've got to source the other information behind that. So when we sit here and we talk, we're delivering facts. We're not making up stuff. And when I say I've got to stick my neck out because I've got to make decisions, it's always within a band. So yes, what people should be doing is, number one, understanding politics at grassroots level, understanding financial building blocks at grassroots level, okay? Understanding trends. Now, this is where it's interesting. A book takes a lot more considered thought than a random tweet or a post. Okay. So again, a book takes a lot more thought than a random tweet or post. So don't shy away from books, be they online or anything, because books are very considered. And you know what? Books can give you reviews and they can tell you straight out what is a lie and what isn't, because there's hundreds of commentators out there that read it. So there are great books out there, and there are great authors out there that are respected. And I mean, I always say there's a great list of books that can be put on this, and people can look at those. And if they're looking for specific subject matter, let's take something, Good Family Business, a book that for me is like the Bible on how to manage family-owned businesses with dynamics of 5 different generations having gone through that. So don't shy away from books. Okay? And while these people are always, and I say this openly, while people are always looking to commercialize their value, people like trend spotters, people like futurists that have respected names, there's a lot of them out there. You need to read where the world can go, and then you need to listen to qualified people. Okay? I'm not interested in Donald Trump's tweet. I'm really not. Okay, but I don't know, I'm just not interested in what he's got to say that morning or what's influencing what he's saying. I'm interested in professional commentators, and professional content is what I'm interested in.
I think that's speak the truth without agenda. And unfortunately, increasingly in the media nowadays, that's very rare.
Yeah, but the one great thing that we do have is to listen, but not hear everything, because with social media, there's so much information out there, but it does create the judge and jury of governments. It creates the judge and jury of the market, and that's what I'm saying is the person sitting is not going to change the world. Donald Trump, right? Whether you're a fan or you're not a fan is irrelevant. But I'm saying governments are being influenced by social media. People are, being judged by social media, by voters. And that's why social media is so dangerous, because it influences voters. So I'm trying to just tell people to focus on good, factual information, and factual information on where the world is going is available. Okay, listen to the hypothetical stuff. You know, you've got to be realistic about who you listen to. I think you can pick up which are the good ones and which are the bad ones, but we can always post a list, preferably. Lean forward to ask a question.
No, just an uncomfy chair, I think. So I've got ants in my pants, but it's all good. I know that so much information has been shared, but you guys are going to be joining us on our breakfasts next week that we are having. And I know you're going to be sharing so much more. We had such positive feedback from the people that attended our breakfasts towards the end of last year and our wealth breakfasts. So what can we look forward to from you guys? What extra nuggets are you going to be sharing with us next week?
I don't know. I was gonna do a personal dance on stage and show you my moves and my waltzing moves, so that you can expect. It's very exciting. Clayton's known to do a bit of stand-up comedy as well, so you can expect that. Yeah, so those will be our, sort of our secondary acts.
Why can't we do this for money?
Yeah, we'll go there later. No, look, I'm so excited about the weekend because the weekend. We've spent considerable money around the world with professional psychologists delving into generational theory, delving into legacy planning and understanding this world. So, while it's very difficult on stage and on, webinars to share all that information, we're dying to get in front of people and say, and give more detail and be available to people because I'm driven by the ability to introduce factual information to people. I'm driven by giving tools to people to go out there and make good decisions. I'm driven by everything we've said to help people get in there. I'm driven by symbiotic relationships with clients where we make money together, not by parasitic historical bank type relationships. So we're dying to get out there and share legacy planning, things that have never been thought about. We're looking forward to having one-on-ones with wealthy people, with anybody who's got a question. Anybody who's got, when I say wealthy people, I mean, remember what wealthy means. It's people that understand their money, it's people that understand their time, and people that are not controlled by their money, that have control over their money. It's not by quantum. Okay? It's very important to remember that. It's people that control their money are wealthy. People that control their time are wealthy. People that understand they're not a slave to their money are wealthy, because it's just a matter of time mastering those principles, which brings about the financial means to do whatever they want to do. So I'm dying to share those principles. I'm dying to be in front of people, and like the last one, I just was inspired by the questions we got. I was inspired by the change that people got, and that was great for us. So yeah, it's we are busy, but I've always enjoyed interacting with the Wealth Migrate community, and being able to share that and bring new concepts and fresh ideas to the world, and also the solid black and white facts and principles of things that you can do out there. So yeah, it's Clayton's in Durban, I'm in Cape Town, Johannesburg, and Pretoria, and yeah, we've also got a couple of our very interesting private equity guys with global opportunities and things that are out there, so people can find out how wealthy people are investing outside of just markets to create income in different ways, to take clever risks, to understand calculated risks. Sorry, that's the word I was searching for while I was mumbling there. But yeah, so that's what we're looking forward to doing.
Thanks very much, guys. We are excited to have you. As you can see on the screen, we've got breakfasts that are happening on Monday, Tuesday, Wednesday, and Thursday around the country. We do have the guys from Calio joining us, so if you would like to find out more information, the link is on the screen. If you guys don't mind, I know that we are on 8 o'clock and we do respect people's time, but we've had quite a few questions that have come through on our question board. So if you don't mind, can we just run through that before we call it the end?
Sure, yeah. US markets are open, so we're quite used to working until 11 o'clock. So we're happy to give another half an hour to questions.
Okay, great, thanks. So just on your questions where you were saying EFTs are quite volatile, a question has come in about what about trackers like this? Is it the SPY or the SPY that follow the markets? Do you have any views on that or not?
So exchange traded notes, acronym ETN. Exchange traded fund, ETF. Okay. These are these passive investments that track the market. I'm going to let Clayton talk about it a little bit more. But yeah, these are passive investments. Passive meaning they track the market. They're not going through a fund manager. They're not buying stocks. They're just buying the S&P 500 track. Okay. It's a passive ETF.
So I think exactly like Ross says, it's essentially creates an index and it owns every single share that's in that index that it's trying to mimic. And they have their important place in investing. However, all I was trying to say is in the context are that like any investment or macroeconomic sort of principle, when we're applying ourselves to where we should be putting money, how we should be managing risk, we are aware of certain things. And at the moment, with the sort of quantitative easing we've seen around the world, with the sort of issues we're seeing with the coronavirus coming through that are hitting very specific industries such as, I don't know if you saw that Carnival Cruises, I think, was suspended yesterday. We're seeing airlines, even some hotels are taking strain. What we're saying is that you don't want to own every single share going into this sort of unknown territory. And that's really what we're saying, is that we in the background, and certainly these are complex macroeconomic cyclical type investment strategies that we have that come with time and understanding at the end of the day. And so I'm not going to go into detail, but I think all we're saying is that not necessarily in the midst of this sort of panic and uncertainty do you necessarily want to own the full index. And I think specifically, if I was to be specific for myself, I don't think you really want to own an index in corporate bonds at the moment because there's going to be a lot of credit issues there. So there's just certain situations. There's certainly no comments on exchange traded funds, etc. They have their time and place, and we use them in our portfolios extensively.
I want to simplify that a little bit more because I said it at the start before Clayton added it. It's a tracker just says it tracks a particular market. So the global tracker is the MSCI, for example. Okay. So you can buy a tracker fund which says, you know what, I don't have time to research, but I just want to get what the global market does. So I buy a tracker fund, and the Morgan Stanley Composite Index, MSCI, you can buy that, and it effectively has sort of 30% in US equities, emerging markets, and it's basically got the blend of the global asset allocation. And it tracks that with very little tracking error. Okay. So people buy these often because they are inexpensive, and they are. But the reason they tend to outperform active managers is because they only have a continuous history. They don't have a time frame of that person's investment. And that's critical because if we use trackers all the time, let's understand that. But if I have a youngster who comes to me right now and says, I just want to put money into the market, what can I buy? I've got 30 years and I want to get all the changes, all the ins and outs of the world and what's happening and technology and everything. I say to him, go put $1 million, whatever currency. Go put $1 million, ruples or, shekels or whatever currency you're talking about. Go put $1 million into the MSCI. You've got lots of time. It will take care of your diversification. And
the volatility is not an issue.
And volatility is not an issue. It was up 28% last year and he's down 14%, 18% today. And it's going to give you a return. And he's going to do that at 0.2%. It's very inexpensive. I'm just seeing some notes here about experiencing network connection. Can you still hear me?
Should we maybe close our camera?
No. But can you still hear me? Fine.
Yep. Yeah, we can hear you.
So they have a place and they're wonderful instruments. The problem is they become very popular. So they hold massive quantums of capital. So you can have 4 billion in a tracker fund, or turn off S&P 500 has got 66 billion. The problem is it's very liquid and it trades very quickly, and it doesn't always allow for the markets to have sensible investments. So tracker funds are getting too big, becoming very dangerous in volatile environments, and that's a large reason why they pulled the plug on Monday. the tracker funds were exiting so quickly. So that they often don't ride out the cycle, so that they can be a little bit too liquid, creating actual damage to the market. So there are downsides to it, and some of them are too big. Anyway, next question.
Thanks. That was a very detailed explanation. Thanks, guys. One from Eugene has come through with regards. Sorry?
I said our world is full of detail. I'm really sorry.
Wasn't a detail.
I can't keep this.
No, you don't have to. It's perfect. I love learning. We all take away so much knowledge from you guys. Keep doing it. We're sponges. Eugene has come and asked about diversification. You mentioned that it's great, and we also believe in the principle of diversification, but how many different asset class is sufficient to reduce your risk?
Okay, so diversification in its simplest form is equities and bonds. Okay, that's in its simplest form. Equities is a very complex area because equities has got lots of sectors. So as simple as diversification can be is to control your risk. If you're on 100% of the market, you have a lower percentage of equities if you don't want volatility. Because these are counterbalance asset classes. Bonds go up when equities go down. So if you want to have half the risk of the market and take half the losses of a subprime crash in 2008, you would have 50% in equities and 50% in bonds. Okay. That's your simple diversification. So those are the only two asset classes that really exist. Right, property falls under equity. Technology falls under equities. So you've got all these equity sectors. So that's where it becomes a complex game. But your basic equity bond exposure will define the ups and the downs that you have in the market, and actually will produce 85% of your return, believe it or not. If you just buy 60% equity and 40%, you've got a balanced portfolio. And if that 60% you bought was just the MSCI tracker and 40% just the LB or the international bond tracker, you'd fare at 60% of the market, you'd take 60% of the downside, and you'd have a balanced portfolio. That's as much diversification as you simplistically need. It's not necessarily going to give you the alpha, which is the upsides. It's not necessarily going to give you 120% of the market return where you only took 40% of the downside. So diversification for me is not about how many asset classes you can hold. It's about income requirement, okay, and what produces income versus what produces capital growth and preservation. So the simplest you can have is 2. That would be the least you have. The most complex you can have is like us, where we've got 60 asset classes because we've got private equity and we've got property and everything. So yeah, it's just to understand that you should be globally diversified. You don't want to hold equities in South Africa because I'm here and think that's the be all and end all of the world. Not a chance. I want to hold equities in proportions to global scale. I want to hold China and I want to hold America, and I want to be able to diversify between emerging and developed markets, for example. So, you might have just equities, but have 50% in America and 20% in, China, for example, when it gets to a cheaper level or even less. And then property, because property can form part of your income side. So, those are some of the more simple diversifications to protect against risk, the principles and the building blocks of what you should do.
Great. Thanks. We've got a question that has come through and asked, are there any tax havens left that invite people to financially immigrate there that will save you on tax in general?
Yes.
Okay, simple answer. Not going to divulge any secrets, so you'll have to reach out to Garth and let him chat with you.
One thing I'd like to say, which I do with clients on that matter, is that just remember though that often you have to go live there and you don't actually want to live there. So this is also about your wealth serving your life and what you want to do. Let's maybe leave it.
Yeah, look, you can live in many places, and we have an old saying about it comes from comes from the, many years back, and it's called, living in the sun and keeping your money in the shade. It's a very powerful statement because it implies that your money doesn't have to live where you live. And are there countries attracting people? Yes, there are countries attracting people. There's still many economies built on finances that had previous economies that are collapsing, and that invite people with very attractive, capital gains rates on property sales, very attractive jurisdictions out there. A little bit more complex in that, if you're running businesses and stuff, that you have to have effective management in those places. I think Isle of Man is offering £30,000 for you to go and run your business in actual Isle of Man and, live on the Rock of Gibraltar, whichever one you want to choose in the tax havens. So these places still do exist. There are still, even in the US. I mean, the US has two tax rates. One is state and one is federal. So you might choose to go live in the US. You make a decision which state you want to live in. And I can tell you, Connecticut is a much more expensive state to live in with state taxes versus the tax-free states of Florida and, Texas, for example, much more attractive tax rates. So yes, there's always preferential tax rate. There's always preferential areas. And yes, there are still places you can effectively manage your money and run it properly, structured correctly, to produce much more efficient taxation on your investments.
There is a question as well about what is the minimum value that, sorry?
I said when we pull the poker face and we freeze, it's the full stop to the end of the question.
That's it, it's done. We're finished, we're moving on. Thanks, guys. What is the minimum investment value that someone has to bring to you for you to take them on as a client? I think you answered that it's just anyone who is serious about looking after their money and are wealthy in their outlook of money, and not necessarily wealthy in rands, although we do understand that the majority of your clients are family offices, which means they do generally have more money than most of us.
We're a style of management. Okay, we're a philosophy of management. We're not a one-man show. I have advisors that are highly qualified, of 27 years old, because I don't interact as well with the younger generation as they do. They are as qualified to deliver our message, our philosophy, and our intellectual property. Our process allows us to get to hundreds of people. When I talk about me spending my time, it's spent with people I've built wealth with, people I've sold companies with. That's where I spend my time. But my passion is financial change to the investor. My passion is symbiotic investing, and we try to reach as many people. That's why we do this. We want to reach as many people. We want to stop as many people making mistakes. And we believe that we can reach a hell of a lot of people, and I can give a one-line answer to an email question that can change a person's outcome over 20 years. And I truly believe that. A person says to me, this and this, what do you think of that? And I'll go, absolute garbage, or fantastic, do that. And that I believe, we're a multi-spread team, very diversified team, and we can get to a lot of people. So I'm not arrogant in if you haven't got 100 million, you're not talking to me. We talk to people, and we talk to people first and foremost to establish their needs and to present to them what they can do. We show value for free until they see the value in us, and that's always been our philosophy. So yes, our minimum investments are not prescribed by us. They're prescribed by where you live, what you want to invest in, and what you want to try and do. It's a South African youngster, for example, comes to me and says, I've got 2,500 Rand a month to invest. Okay? 2,500 units, if you don't know what the Rand is out there globally. I've got 2,500 units a month to invest. You know what I'm going to do? I'm going to say to him, go to the bank and get a 200,000 Rand property if that's what your payment can afford to pay off, because now if I get 10% on a property, okay, of 250, I made 25,000. If I get 100% of 2.5, I made 2,500. Simple advice, using the bank, using gearing for him to get ahead, to gear up an investment, and rather spend the money servicing the debt on the bigger investment. When he gets a little bit more, he kills that debt much quicker. So, we're brutally honest about what's the best direction to invest with the quantum of money you have to invest.
That's awesome, and I think that that goes with our philosophy on why we partnered with you guys, for the trust and the transparency. You guys aren't going to pull the wool over the eyes of our investors just to get them into your environment, and the advice that you are going to give and that you have given to our investors that have partnered with you from our previous events has been phenomenal. The feedback has been great. So anyone who is looking for any advice in that, please do let us know, and we can put you in touch with Garth or Clayton. Come to our breakfast, you can meet them. Otherwise, you can send them an email. Their advice is invaluable. And our last question is about, you touched on this briefly, but this is a direct question relating to Wealth Migrate and estate duty. So if we've invested in Wealth Migrate, is it better for estate duties to use a PTY Limited, a property trust, or in our individual names if it is only the small minimum investment? So I am assuming the small minimum investments is either the $10,000 or the $1,000 investments.
So I'm assuming by setting limited, the investor is South African.
Yeah.
So that's the first assumption I'm making. And, here you've got a loaded question, because it speaks to the ability for a company to have a 10x event. Okay.
And to get the money overseas. And then
yeah, I would do that in my personal name because of the complexity of trying to hold a internationally registered IP, for example, in a PTY Limited. I would take the money in my name offshore, and I would purchase it directly in my name offshore, because anything that you try and do within that might be unraveled in South Africa going forward. Whereas if you go through the South African Reserve Bank process and you take that money offshore, there's a level of protection provided to that. If the 10x factor happens, remember the multiples of rands with our weak currency. It really has to grow significantly to be a hard currency estate duty issue. And as I said, for me, I would hold that in my personal name. And when we get to the value nearing a 3.5 million, which is the South African estate duty abatement per individual, if we feel that 10,000 is now going to exceed that, and we're getting close to that NAV or that share value equaling that, then you can start making a different decision. And we do have structures in 18 months to be able to transfer from personal name to other areas, and to do that all within perfect legal mechanisms. But start now in your name and then monitor your investment. And as you start growing and getting close to those numbers, then you make your decision to change your estate planning. Okay.
And that's why ongoing advice is needed in these things.
Yeah, it's a hard question to answer because, well, it's easy. Do it in your own name at that quantum. If it's the minimum, definitely do it in your own name. The rest is just too complex. You've got shares, accounting fees, and everything, and you're going to erode your investment until it's achieved that level. So I would monitor the investment. I would know what my estate duty levels are, when I have to look at it again, if it hits this share price, etc., and I'd base my decision on that. I wouldn't look for anything outside of investing in my personal name on a minimum quantity.
Thanks, guys, and thanks to everyone who has been on our webinar. That is all the questions that have come through on our question block. So this has been so much information that you guys have shared. We really do appreciate you being online and sharing with our community. We've had a few people that have said, great, booking our tickets now. So clearly you're going to have a run on you at the event. So we look forward to that. Any closing thoughts from you guys or comments?
Panic slowly.
I think also prepare for opportunity. I think you need to be positioning yourselves now to go after great opportunity, because even if we see the worst of the coronavirus, whatever, things, the clouds will move away, the sun will come out, and there'll be great opportunity again.
Yeah, my closing statement is if you just thirst for knowledge in this game, the knowledge is available, and just keep educating yourself. The more homework you do, the greater your outcome will be. You know, the more time you spend on planning, the less time you chase returns, the higher your return is going to be. Don't try and time the market. Build your plans, stick to your plans, and get somebody to help you draft those plans. That's my closing statement. You know, keep educating yourself, and then you will be in a position to make informed decisions. And I'll close with that little investor Warren Buffett statement, because I just think it's so appropriate. And you know, with coronavirus and oil and everything, you know, here's the master of emotional control in the markets, Warren Buffett. And he said, you know, be fearful when others are brave, and be brave when others are fearful. And it's a cliched statement in the investment world. But people hear cliches, but they don't, until they've experienced, understand them. Remember that, write it down, and whenever you feel like you're making an emotional decision, ask if you're being brave, or ask if you're being fearful, and ask what the greater global community of investors is doing. The moment they're fearful, are you brave? Are you looking at the opportunities? So yeah, I just think that's a fantastic line for any person going into the investment world to always have as, you know, a founding statement when they make decisions. All right, well, there's a close for me.
Thanks, guys. Closing from you, Aubrey, before we say goodnight to everybody.
Yeah, I just want to say thanks to you guys. That was really brilliant. I learned a lot, and I look forward to cornering you guys at the Cape Town breakfast and really picking your brain a little bit more. Appreciate it.
Cool. Guys, thank you.
Cheers, guys. Thank you.
Cheers to everybody out there.
And to all our attendees, thank you for spending this hour and a half with us. We know that you chose to be with us when you could have been in other places, so I hope you gained as much knowledge as we did. We look forward to seeing you at our events in the next week and sharing with you after the events as well. So take care, everybody, and have a good evening.
Cheers.
Cheers. Bye-bye.